As was widely expected, on Wednesday, the Federal Reserve moved to push interest rates higher, their second such adjustment to rates so far this year. In this morning's U.S. Bank Economic 360, U.S. Bank Senior Vice President Mike Denneman joins Business Courier publisher Jamie Smith to talk about what this means for the market and for your money. Mike and Jamie.
Thanks, Peg. Mike, thanks for being here as always.
Good morning.
So tell me, what exactly did the Fed do?
Sure. So on Wednesday, they raised their so-called Fed funds rate by 1/4 of a percentage point. So important to remember, we've talked in the past, the Fed doesn't actually control interest rates, but what they do is provide guidance through this Fed funds rate, and then generally everybody follows along. So, you know, the markets, banks, financial institutions. So they've moved Fed funds rate higher by 1/4 percentage point, so their target now for short-term rates is 1 3/4% to 2%. So still not terribly high, of course, but recall that, you know, just a year or so ago it was essentially 0. So the trend has been higher, and with this most recent move, we should expect that trend to continue even higher still.
So it's, you know, good news, bad news?
You know, it depends on your perspective. If you're a borrower, probably not. If you're a saver, probably yes. But in the grand scheme of things, it is mostly good news. You have to keep in mind that the Fed raises rates when the economy is doing well. Right. And so what this tells us is that the Fed sees that the economy continues to improve. Certainly we had just a couple of weeks ago a very strong unemployment report. And so that, I think, sort of cemented in the Fed's thinking that now is a good time to raise rates. But kind of a natural question is why? Why do they want higher rates? And one of the primary reasons is to help keep inflation under control. One of the downsides, unfortunately, to a stronger economy is higher inflation. And so a little inflation, not bad for the economy. Too much inflation, not a good thing. And so higher rates keep inflation under control. And so that's the Fed's primary objective here. Not a lot of inflation yet, but trying to head it off at the pass.
Did we see any reaction from the market?
Very little. Very little, and that's the good news. As Peg said, this was a very widely expected event, and so we've certainly seen in the past the Fed can throw the market a curveball, and when that happens, things can get ugly. So the process works best when the Fed is upfront about what their plan is, and then they follow through with that, and so that's what we saw this past week. The market was down a little bit, but pretty much a non-event, and so things are working as they should. The Fed also let us know that they expect 2 more interest rate increases between now and year end. So of course, very important to have that information. Knowing that beforehand gives the market time to prepare. So certainly something that we can...
I'm sure we'll talk about it again in the third quarter, right?
Absolutely.
All right, well, thanks so much for being here.